Okay, so let's start. Uh, right. Okay. Last week we discussed the points relating to the project appraisal, and we discussed the question at the end of the chapter. I think we discussed all the questions. Right. So we can start the next topic. That is the topic number 10. Right. In topic number 10. Uh, that include the right. In fact, we discussed last at the beginning this project appraisal, so that include number of steps. So initially we discussed what are the main techniques that can be used to evaluate capital investments, right? In chapter number 10, in chapter 10, so we are going to discuss what are the main principles that should be followed, and we in fact, so number of points related to this chapter 10, we have already done. Only we have to spend only few minutes to discuss the key principles here, which we have already done, and we can directly do the question, comprehensive question relating to this project appraisal, right? Uh, because we know this evaluation of capital investment, which is commonly known as project appraisal, is based on number of principles. When we discuss the key technique used to evaluate capital investment, most of these principles we have already discussed. That's why I mentioned we don't need to spend much time. So that is known as the principles of project appraisal, right? Principles of project appraisal. Uh, we can discuss first of all we can discuss principles of project appraisal today. So you will see most of these points we have already done, right? Except one or two points we have done, right? We discuss usually when we are evaluating a project, because this project appraisal is entirely based on estimates. This analysis is based on estimates, right? That means before a company is going to start a capital investment, they should know what are the benefits that can be expected from this project, and that should be compared with the cost of this investment. So that's why we discuss different techniques used to do that evaluation. When we are estimating when we estimate the benefits of a project, right? We discuss what is the best measure of the benefits of a project. The benefit should be measured in terms of what? The best thing is, because benefits we can measure using different measures, but best thing is the measurement of the benefit should be measured in terms of
OP, absolute terms.
Yeah, absolute term means, there are different measures we can estimate for the benefit. The benefit we can measure in terms of profit. Benefit we can measure in terms of what, right? Cash, right? The best thing is cash flows. We discussed the best measure of the benefits of a project is the cash flows, right? Therefore, that one main principle in project evaluation, decisions should be based on cash flows, right? Decisions should be based on cash flows, because we already discussed what are the problems of using profits, right? Decisions should be based on cash flows, right? Cash flows, not earnings, not profits, right? Cash flows, not profits, not earnings, right? Because we already discussed what are the problems of using profits to project appraisal exercise, right? Because if the company is going to compare different projects using profits, that is not the correct decision. The company will not select the correct project. So the first principle of project appraisal is the decision should be based on cash flows, right? And when the company is estimating cash flows, right? And when the company is going to use cash flows to evaluate the project, all the cash flows should not be used, right? Company should use only relevant cash flows. Relevant means what? What is the meaning of relevant cash flows? Because when we are evaluating a particular project, there may be so many cash flows associated with the project. But we need to consider only the relevant cash flows. Relevant cash flows means what? Right?
The cash flow that is will be generated out of the project.
Yeah, so right, that's correct. So will be right, not only generated, and that should be incurred specifically for this project, right? That should be incurred, or that will be generated from the project. In other words, we call this incremental cash flows, because the company may have to incur certain cost. Whether they accept the project or not, they have to incur. Then it is not relevant. It is not incremental. Then the relevant cash flows are right. There are several things we should consider when we estimating cash flows. One thing, the cash flows, right? Only relevant cash flows should be used. What are the relevant cash flows? Relevant cash flows are the incremental cash flows, right? Relevant cash flows are the incremental cash flows, right? Incremental cash flows. Incremental cash flows, right? Incremental cash flows, we normally in management accounting also we use this term. For the incremental cash flows, we use another term. We call it differential cash flows. Differential. That means due to this project, there should be a difference, right? Because there are certain cash flows, whether this project is there or not, company has to incur that cash, right? Sometimes the allocation of certain cost, administration cost for the project, they will allocate certain part of the company's current administration cost. But even if this project is not there, that cost is there. Then it is not incremental. It is not differential, right? And that's why we have to identify what are the cash flows that will be specifically generated from this project that should be incurred due to this project. What are the additional incremental cash flows, right? So what are the relevant cash flows? Relevant cash flows are the incremental cash flows. Because there are certain cash flows that should be incurred, but whether the project is accepted or not, it cannot be recovered. There is a category like that. So what is the term used for that type of cash flows? There may be certain cash flows the firm has to spend for this project, but even after incurring that, so the company have to evaluate the project. Even if they decide the project is not acceptable, that cannot be recovered. If there is a cash flow like that, then is it incremental? That is not incremental, right? That is not incremental. That means due to the acceptance of this project, there is no change, right? So if there are certain cash flows which should be incurred, but it cannot be recovered, even if the company decide to reject the project, what is the term you use for that type of cash flows?
Sunk
cost. Sunk, right? So, right, that term explained very clearly, sunk, right? Sunk cost. That means if there are any sunk cost, firms should not consider that, right? That's why we call sunk, right? Sunk cost should be excluded, right? Sunk cost should not be considered. Sunk cost should not be considered. Right? That means if there are any sunk cost, that should be excluded. It should not be considered. Right? So especially for project evaluation, what are the examples for sunk cost?
Research,
right? For certain projects, research and development expenditure should be incurred, right? So then after company spend for the research and development, and after the evaluation, they identify the project is not viable. It's not right possible. But that cost cannot be recovered. Therefore, it is not increment. It is not differential. So sunk cost, right? Research. So certain projects require feasibility studies, due diligence studies, right? So these are we call sunk, because these are not sunk cost means these are historical, right? That means at the time of accepting the project, these are historical cost. That means due to the decision, right? If the company decide to accept the project, this cost cannot be changed, right? So that those are the important things to identify sunk cost. Sunk cost means that is historical, which cannot be recovered, which cannot be changed due to the management decision. Sunk cost means the cost that cannot be changed due to the decision, which are historical. This is a historical cost which already incurred, which cannot be recovered. If there are some costs like that, that should not be considered in project evaluation technique, right? In project appraisal. So sunk cost should be excluded, should not be considered. Right. Then, so when we identify these incremental cash flows, there is another important point. There are certain projects, right? If the company start a new project, suppose the company start to produce a new product, that can affect to the other operation of the business, right? A particular project, if the company start a new project, that can affect the existing operation. Then it might affect the existing revenue cost. It can affect. Then is it relevant or not? Is it relevant or not?
No.
That is relevant because because that is incremental. That is incremental because it is not only to the project, right? Project cash flows, it can affect to the other operation, right? What is the term you use for that type of cash flows? We call it, right? So I'm sure you have learned this.
Opportunity cost.
Sorry, no.
Opportunity cost.
Opportunity cost means actually that is something else. This is opportunity cost also very important concept. That is one main principle in project appraisal, right? So we'll discuss that in a minute, right? So this is the project can affect to the other operation, right? Opportunity cost means we have to sacrifice some alternative, right? So that means we have to select one alternative. So that should be considered, right? But here the project can affect to the other project or other operation. The new product can affect to the other products. This is called, right? We call this externalities. Externalities, right? I remember even in our school we learned this in economics, right? I remember our economics, right? She said bahirata, externalities, right? In fact, she said there are two types of externalities: externalities in production and externalities in consumption, right? Right? So that means it can affect to the others, right? But here, when it comes to project appraisal, new product or new project can affect to the other projects. That is called externalities. That is relevant. Why? Because it is incremental, right? Because this also can affect positively or can affect negatively. For example, when the firm decides to produce a new product, right? So what are the possible externalities? Due to the new product, it may affect the existing product positively. Due to the new product, the demand for the existing product also can increase. Then what is that? That is a positive externality, right? So that is a positive externality. But sometimes, when the firm introduce a new product, that can affect negatively on another product, right? So special term also used for this type of externality. For example, if a company introduce a new product, so the demand for the new product will be there at the cost of another existing product. We use special term for that. That is called, I'm sure you know, cannibalization. We call this cannibalization, right? So that type of conditions may be there due to certain projects, right? So these are relevant. Why? These are incremental. That means externalities. We call them externalities. Externalities. If there are externalities, that should be considered. Externalities should be considered. Externalities should be considered, right? That means if the new product can affect the existing products or existing projects, that we call externality. It can affect positively, it can affect negatively. Both, right, factors should be considered. If there is a positive externality, that should be incorporated as cash inflows. If there are negative externalities, estimated cost should be included as outflows, right? So these important points should be considered in estimating cash flows, right? Then the other important point you already mentioned, sometimes there may be certain important thing, but there is no real outflow of cash, but it is important, right? The point you mentioned, opportunity cost, right? For example, suppose company is going to start the new project in their own building, right? Own building. So that means there is no new cash flow. There is no additional cash flow, right? They have already constructed the building, so they are going to start the project in the existing own building. Is there a relevant point here that should be considered? Is there relevant cash flow due to that particular point? company is going to start the new project in their own building, which they have already constructed. Is there any relevant point to incorporate to this analysis?
The cost of space, which we can rent it and earn, or something like.
Exactly. What is that? So that is what you mentioned earlier as opportunity. There is no real outflow of cash, but there is opportunity cost, right? Why? If the company is not going to start this project in the building, they can earn rent income from this building. But if they start the project in the building, in their own building, they lose the opportunity to earn some other revenue from this particular source. That means there is opportunity cost, right? Opportunity cost should be considered. That means cash flows should be estimated, right? Cash flows should be estimated on opportunity cost basis. Opportunity cost basis. Cash flow should be evaluated on opportunity cost basis, right? So that means even if there is no explicit the actual cash flow outflow of cash, but if the company has opportunity cost, that should be considered, right? Cash flow should be estimated on opportunity cost basis, right? Then the other point also we already discussed, when the company estimate cash flows to evaluate the project, which cash flows we should use? We should use the cash flows before tax or after tax? We already discussed.
Cash flows after tax.
After tax, right? Cash flow should be estimated on after tax basis, right? That also we discussed. We did some calculations also last day, right? Cash flow should be estimated on after tax basis, right? After tax. Because we want to know what are the cash flows company can retain. If the company use cash flow before tax, then we can't see the increase in value to the owners. We can't see the increase in shareholders' wealth, because part of that should be paid to the government. So that's why we have to use cash flows after tax. That also we have already discussed. And the other point we have discussed throughout this module, right? We know we have to write not only the amounts of the cash flows, what is the other more important thing? Timing of the cash flow is very important. So that's why in project appraisal, it is essential to adjust time value of money, right? So timing of the cash flows should be taken into account, right? So timing of the cash flows should be taken into account. Right. So that also we have already discussed. Right. Okay. Maybe this may be a relatively new point. When we estimate the net cash flow, right? Suppose the firm has financed this new project using debt capital. If the company use debt capital, maybe suppose company obtain a loan to finance the project. Now we know for this loan company has to pay interest, right? We know cost of debt, the interest. Then when the company estimate the net cash flow from the project, the interest cost paid to this loan, we need to deduct or we should not deduct. When we calculate the net cash flow after tax right to evaluate the project, the interest cost paid to the debt capital, we should deduct or we should not deduct.
We should not deduct.
We should not deduct. Why?
It's already deducted in the PN.
Where?
Interest cost on the profit and loss. When you get your profit and loss.
Here actually, what we need is we are not going to calculate profit. So here we need the net cash flow after tax. When we calculate, in fact, we need to calculate profit to calculate tax, right? That means, so that's why I asked. So when we calculate the net cash flow after tax for project evaluation purpose, the interest cost we should deduct or we should not deduct. The interest cost, yeah.
Yeah, because funding is different.
Should not this.
Should not. Why?
Should not take into account because it depends on the way of funding. If it's shareholder funding.
No. I mean, if the company has obtained a loan, if the company has obtained a loan or maybe debenture or a bond, the company has to pay interest for that. I'm referring to that interest cost, right? Suppose they have finance using debt capital, right? So they are planning to finance using debt capital, right? So now they have decided they're going to finance the project using debt capital. Let's say even a part of certain percentage in debt capital, then they have to pay interest for that debt capital. So I'm referring to that interest cost.
You
That
should
interest
deduct.
cost, yeah,
You
we should
should
deduct
deduct.
or we should not deduct.
Deduct.
Should deduct.
Should
We
deduct.
should deduct. Right. Okay. In fact, we should not deduct. Right. Because in project evaluation, so what we do when we know we discussed last week. So when we calculate the net cash flow, then in order to calculate this NPV, what we do? These cash flows we have to
Discount.
right. What do we do? The cash flows we discount. What is the discount rate? Right now,
Yeah.
in this way, when we estimate the cash flows, we have to discount. Discount rate means what?
Cost of capital.
Cost of capital.
Yeah.
Discount rate is the cost of capital, right? So interest cost we incorporate into what? Incorporate into the discount rate, right? So when you calculate profit for a particular firm for the last year, we deduct interest cost because there we don't discount. But here, for project appraisal analysis, project appraisal study, we don't deduct interest cost. Why? The interest cost is included in the cost of discount rate. So that's why we discount cash flows, right? So what will happen if we deduct the interest cost? We deduct the
Duplicate.
interest cost and we discount. So that is not correct, right?
Double
So
discount.
double count. So there will be a double counting problem, right? So that's why when we estimate cash flows for project evaluation, right? This is for project evaluation, right? So not to calculate the profit for the previous year or the current year. So because we calculate profit in the financial accounting based on historical information, right? So financial accounting means that is completely based on historical information. There are no projections, right? But project appraisal, that is completely estimate, right? So therefore, here what we do, we need to discount cash flows. Discount rate is the cost of capital. Therefore, finance cost should not be deducted. Why? Finance cost is included in the cost of discount, right? The finance cost.
Excuse sir, even that time cost of the cost of for the time period also is in the cost of capital, is it? So it will be higher than the interest rate.
Yeah, so that's why one limitation in NPV. What is that? We discuss one limitation. We assume cost of capital remain unchanged. That is a challenge we face in project appraisal, right? So time period. So that's why it's more appropriate, more accurate if we can calculate the cost of capital separately for different years of the project. But that is highly challenging. So which is not. So that's why we use the same discount rate for the entire period of the project. But as you very correctly mentioned, time period also affecting to the this cost of capital, right? So that is true, right? But that challenge is there, right? So so finance cost. That means actually we are referring to the interest cost, right? Interest cost should not be deducted. Should not be deducted in calculating net cash flows. Net cash flows since it is included in the discount rate, right? Discount rate means it is the cost of capital, right? Discount rate means it is the cost of capital, right? So right, finance cost should not be deducted. Okay, so that is one important point, right? So when we discuss cost of capital, which is also, I think topic number 12, there we'll discuss in detail how to calculate this cost of capital, right? So we should not deduct finance cost in project evaluation analysis, right? Exercise. Then another point, inflation. Inflation is one important factor that will affect this project appraisal exercise, right? Inflation. Because inflation can make a significant impact on cash flows, and it can affect cost of capital. Because, right, interest rate, inflation can affect both cash flows and discount rate. So how to adjust that? How can we adjust this inflation when we are doing capital investment evaluation? Because inflation can affect the cash flows. Inflation can affect the discount rate. In fact, this also we have discussed, right? We have discussed.
You keep a margin of provision or margin of safety.
Right. So that means for inflation, right? So actually, if inflation can affect both cash flows and discount rate. So then to adjust this, to apply this correctly, we have two main methods. One thing, we can estimate the cash flows with inflation, right? We can estimate cash flows with inflation. If we estimate cash flows with inflation, that means, as you mentioned, after estimating a certain percentage for inflation, so what you call as a margin of safety or something, right? So that means we can, after using historical and current information, we can see for the period of the project, this will be the estimated inflation, right? And that can be adjusted, that can be incorporated to the cash flows. Then what will be the cash flows? We use right, if we include the inflation to the cash flows, then those cash flows we call which cash flows? Those are, right, with inflation and without inflation. You remember the two concepts we discussed. With inflation, without inflation. What are the two concepts? We discussed this with respect to the interest rate. Interest rate we can analyze with inflation.
Nominal rate and real rate.
Exactly, nominal and real. Nominal and real, right? So whether it is interest rate or any other concept, when we consider with inflation and without inflation, those are the two terms, nominal and real. So if we estimate the cash flows with inflation, then what are these cash flows? The cash flows are nominal. If the inflation is included, that is nominal, right? That is nominal. Real means after removing the effect of inflation, right? So you remember we discussed interest rate. Right now, if we estimate the cash flows with inflation, what should be the discount rate we should use? We have to use the discount rate with inflation or without inflation. Discount rate also we have to use with inflation. That means what should be the discount rate? What should be the required rate of return? It should be nominal required, right? So if we use nominal cash flows, discount rate also should be nominal. Oh, we can estimate cash flows after ignoring inflation, right? So we can see, right? So this is actually, as you mentioned earlier, suppose currently the price of the product that the company is going to sell, the company has calculated. Then what they can do, so if the period of the project is 5 years, what they can do, they can incorporate inflation. So this is the current price, but we assume the price of this product will increase with inflation. Therefore, this will be the price in the first year. This will be the price for the second year. This will be the price for the third year. So in this way, we can include the inflation to the price and estimate the cash flows. Then cash flows are nominal. If the cash flows are nominal, discount rate should be nominal. The other method, we can use the current price. We don't adjust inflation. We don't adjust inflation. We consider this is the price of the product, and for the entire period of the project, we are going to use the same price, and we estimate the cash flows. Then what are the cash flows? Then these cash flows are, right? The cash flows are, these are real cash flows. Why? We have not included inflation to the cash flows. Then the cash flows are real. If the cash flows are real, what should be the discount rate we have to use? We have to use real discount rate, right? So that's why when In order to adjust inflation, we have two methods. What are the two methods? Nominal cash flows should be, right? Either nominal cash flows should be used with nominal required rate of return, or real cash flows should be used with real required rate of return, right? Either we have to include inflation to both cash flows and interest rate, or we should remove inflation from both cash flows and discount, which means inflation should be treated consistently, right? So that is very important point which will affect the project evaluation exercise. Inflation should be treated consistently, right? Consistently. That means inflation should be treated consistently, which means nominal cash flows should be used with nominal required rate of return. Nominal net cash flows should be used with nominal required rate of return, and real cash flows should be used with real required rate of return, right? So real net cash flows should be used with real required rate of return, right? So we'll do some example to identify this, to check this. When you use consistently, whatever the method you use, you will get exactly the same answer. In fact, you may remember we applied this concept earlier for some time value of money calculation, right? So I remember one question which include inflation. So we discussed how to calculate the net present value with inflation and without inflation. So either we can include inflation to the cash flows and use nominal interest rate, or we can exclude inflation from the cash flows. We can use real interest rate, right? So these are the key principles. These are the key principles of project appraisal, right? So when a company is evaluating a capital investment, these are the key points that should be considered, right? As I mentioned earlier, most of these points we have already used in previous calculations, right? So and only thing we can see this after tax also we did some calculation and inflation. So the effect of tax on inflation and effect of inflation on project evaluation, those 2 points. So we can see because in this topic, in topic number 10, the key points relating to the estimation of estimating cash flows, these key principles are given here, right? So in here actually one point is given under number of points. So there I summarize for your easy reference, right? And so the main points we should discuss: what is the effect of tax on net cash flows, and what is the effect of inflation on net cash flows, right? So those are the two points we need to discuss. After that we will move to the detailed questions, right? So what we'll see, in fact this the effect of tax on cash flows we already discussed, right? We did some calculations right? But so we'll see, so we can adjust that in 2 ways. One method I mentioned when we discussed ARR earlier, right? So this is another method. So I already discussed after tax net cash flows we can calculate, right? After tax net cash flows we can calculate this way, right? So one method, the method we discussed so far, right? The method we discussed, what is the method we discussed, which is given in this study text? We can so I think in topic number 10, right? So we can calculate this way: R minus C, revenue minus cost. Then from this we can deduct depreciation, right? So revenue minus cost minus depreciation, right? And from that, right, this can be, we can adjust tax to this value, right? So this is what we did. and then we have to add back depreciation. Right? This is the method we use. Is that clear? Because in order to calculate the net cash flow after tax, this is how we calculated earlier. Right? In fact, earlier I mentioned this in vertical format, now horizontal format. Whether it is vertical or horizontal, method is same. Right? So this is what we discussed. What we did: cash revenue minus cash expenses, and from that we need to deduct depreciation. Then we adjust tax. Then for that we adjust add depreciation. So that is the same thing I wrote in vertical form. Sorry, horizontal form here, right? Is that clear? R means cash revenue, right? R means cash revenue, right? R means cash revenue. Then cash revenue. C means cash cost in this formula, right? Cash expenses. Cash expenses. Then D is depreciation. D means depreciation, and you know T means the tax rate, right? So in this way, we can calculate after tax net cash flow, right? Net cash flow after tax. Is that clear? R, cash revenue minus cash expenses, and from that we can deduct depreciation. That can be multiplied by 1 minus T. So it is similar to deduct tax, right? Only tax, right? So then we add back depreciation. This is one method we discussed. In fact, there is another method to calculate this, right? Net cash flow after tax we can calculate using another method. That is, right? You know the reason to deduct depreciation here and we add back depreciation here. Why is that? Why we deduct depreciation here, then we add back depreciation here, right? What is the meaning? Oh, what is the purpose of doing this adjustment? What is the impact from depreciation to this calculation?
You need to work out the tax component by adding the depreciation because it's a provision. And
Exactly. So the meaning, the purpose is to adjust tax benefit on depreciation. Tax benefit on depreciation, right? That's why we deduct depreciation here before calculating tax to get the tax benefit, and we add back depreciation because it's not a cash flow. It's not a cash flow, right? Right, as you correctly mentioned, the entire idea of deducting depreciation here and adding back the depreciation here, this is to adjust the tax benefit on depreciation. We can adjust this in another way, which means we directly deduct cost from revenue and we calculate tax. But we know, as according to accounts, this is not correct because tax we can't deduct from cash flow. Here we have calculated the tax on cash flow, right? Based on accounting concepts, this is not correct. But in order to calculate the net cash flow for project evaluation, if we do this, but here we can see here one point has not been adjusted here. What is that? The tax benefit on depreciation has not been adjusted. Therefore, what we can do, we can add the tax benefit on depreciation. The only reason to deduct depreciation here and adding back here is to adjust the tax benefit. Now, if we calculate this way, what should happen? We should get exactly the same answer. We should get exactly the same answer, right? So now you can check these two formulas, right? You can check these two formulas, right? Under this, the effect of tax on of tax on net cash flow, right? So here that is in page number 100 and in page number 152 there's a small example. There's a small example in page number 152, right? So let's do this example using both these methods, right? So calculate now. So here one example is given. Assume that the project's net cash flow is expected to be 10,000 per annum, right? So net cash flow means what? Net cash flow means right? Net cash flow means directly they have given. So in this analysis, net cash flow means what? R minus C. R minus C means net cash flow. The cash revenue minus cash expenses. Net cash flow. R minus C. That means this 10,000 means R minus C, right? Then it says for tax purposes, depreciation charge is 1,000 per annum. right? R minus C is 10,000, D is 1,000, right? D is 1,000, right? And the tax rate is given. What is the tax rate? Tax rate is 39%, right? So now this information, right? This information given in this question, right? R minus, these are the information given in this question. R minus C value is given directly, right? So R and C not given separately, the figure given for R minus C. R minus C is given, D is given, that is 1,000, and the tax rate is given. The tax rate is 39%. Tax rate is 39%, right? So now you can apply both these method and calculate the net cash after tax net cash, right? So calculate quickly. I calculate quickly based on these two methods, right? So if this, from both methods, you should get the same marks, right? So please calculate. R minus C is there, right? So when you apply to this formula, what will be the answer? So you, right? So you can see R minus C is given. R minus C is given, that is 10,000. That is 10,000. The depreciation is, right? Depreciation is, right? So 10,000 is given. 10,000 is given, that is R minus C. And from that, we need to deduct depreciation. That is, right, 1,000. That is R minus C minus D. Okay. Then that should be multiplied by 1 minus tax rate. What is the tax rate? 39%. Right? Then we need to add depreciation. Right? So we can put, right? So it's better if you calculate manually. Right? So now, one disadvantage of using Excel, you wait until the answer appears in the Excel sheet to note down. Right? But better to calculate. Right? So now when you calculate this way, what is the answer you get? What is the answer? What is the net cash flow after tax?
6490.
6490. 6490. Right? That is the answer. Right? So calculate this way also, because the entire purpose of deducting depreciation here and adding back depreciation here is to adjust the tax benefit on depreciation. So we can adjust that this way also, right? So you calculate this way also. R minus C given directly. R minus C is given. That is 10,000. Then that we need to multiply by 1 minus T, right? 1 minus T. Tax rate is 39%, right? Then so that the answer we get here. So what we need to do? We need to add tax benefit on depreciation. So depreciation is given, the tax rate is given. Right. When you calculate this way, what is the answer you get? What is the answer?
Same answer.
Same answer. You should get the same answer. Right? Why? Because it is, right? The purpose of adjusting the tax benefit is, purpose of adjusting depreciation here is to adjust tax benefit. Therefore, definitely you should get the same answer. You should get the same answer. So that's what you identify here. These are the two methods that you can adjust tax, right? These are the effect of tax. So tax can be adjusted this way. Okay, so that is not a difficult point, so which we discussed last day, right? Also, right. Then we'll see what is the effect of inflation on cash flow. That also not a completely new thing, right? So you already know this point, so we don't need to spend much time, right? So effect of inflation on cash flow, we already discussed. We have two methods to adjust inflation, right? So what are the two methods? Because we know inflation can affect cash flows, inflation can affect discount rate. To adjust that, we have two techniques. What are the two techniques? We can use nominal cash flows and nominal required rate of return, or real cash flows with real required rate of return, right? So we don't need to spend much time. There is an example in the study text. We'll do that right before we are moving to the detailed question, right? So if you see the question in page number 153, in page number 153, small question is there, right? Assume that investment of 1,000 is expected. Okay, these are the details given here, right? the cash flow at time 0. Safe, right? What is the investment? The investment is $1,000. Investment is $1,000. Investment of 1,000 is expected to generate net cash inflows of 500 at constant prices. What are, right? This is the investment. This is the investment. This is the investment. Then, right? This is the investment cost, and then it says that net cash inflows, right? The cash inflows given, right? Cash inflows. What are the cash inflows? It is given expected to generate cash inflows of 500 at constant prices at the end of each of 3 years. 500 at constant prices. Constant prices. Right? Constant prices at the end of each of 3 years. Right? At the end of each of 10 years. Each of 3 years. Each of 3 years. Right. Now, these details given. Right. Then what is given? The expected okay. Prices are expected to increase at the rate of 10%. That means what is this 10%? 10% is the 10% is the inflation. Inflation is 10%. Right. Inflation is 10%. And then it says the nominal required rate of return is 15%. Nominal required rate of return is 15%. Right. These are the information given. These are the information given. So we have to calculate NPV. Right. So we need to calculate NPV. So right. So it's okay even if you so look at the study text now. All the information here. Right. So to see the effect of inflation on cash flows, we need to calculate NPV for this project. Right. Simple example. Very simple example. Right. Investment is $1,000 and these are the cash inflows. 500 at constant prices. That means what are these cash flows? Right. So one thing to calculate NPV for this project. Right. If you want to calculate NPV for this project, so what we can do, right? NPV, to calculate NPV for this project, we can use, right? We know the method. Cash flow for the first year should be discounted for 1 year. Cash flow for the second year should be discounted for the 2 years, right? So you remember how to calculate that, right? We know net cash flow for the first year should be discounted at 1 plus I to the power 1, right? To the power 1, right? So you remember how to calculate that. So in this way, we need to calculate the cash flow for the 3 years, right? So this is the cash flow for the second year, and this year to the power 2. This is the cash flow for the third year, and it should be discounted for 3 years, right? So, and from this, what we need to do, we have to deduct. We need to deduct cash investment, right? So this is right. So I will put cash flow at time 0, right? So you know this is how we calculate. In fact, these 3 values you need to add, right? So when you add, so this is how you calculate NPV. This is what you have to, right? This is what you have to calculate. Now, one method to calculate NPV, right? So you can calculate NPV. So the net cash flow for the first year, we can put this way. Cash flows we can put this way: 500 for the first year, 500 for the second year, 500 for the third year. And what is the cash flow for the? In fact, what is the investment? Investment is 1,000. Right. If we put the details this way, what are these cash flows? These are which cash flows? We can calculate NPV using the cash flow in this order, right? In this form, right? If we use the cash flow in this form, what are these cash flows?
Nominal cash flows.
Sorry?
Nominal cash flows.
Nominal cash flows. These are nominal. It is nominal cash flows.
Real cash
Right.
flows.
Sorry?
Real cash flows.
These are real cash flows. Why? These 500
Constant prices.
constant prices. Constant prices
Okay.
means, constant means if the price level did not change. Constant, right? So this term you may have seen even if you when you are referring the central bank annual report, when you see the GDP, GDP, you have seen two values. What are two values?
Constant
Nominal
and real.
GDP. Exactly. So, right. So, nominal GDP, real GDP. Real GDP means what? Constant prices. If the price level did not change, right? So, similarly, constant means what? Constant indicate this is when the price level did not change. Price level did not change means what? That means inflation is not included here. This is without inflation, right? Constant prices means this is, right? Constant prices. Constant means this is without inflation. If the price level did not change. These are the cash flows if the price level did not change. That means, what are these cash flows? These are the real cash flows, right? So these are the real cash flows, right? Real cash flows. If we use the cash flows this way, right? Now, what is the next question we need to consider to calculate NPV? What is the discount? Now, what is the discount rate we should use? What is the discount rate we have to use to calculate NPV here?
Real discount rate.
Real discount rate. What is that rate?
15 minus 10.
15 minus 10.
No.
Is that correct? 15 minus 10 means what is that real rate? That is approximate. That is the real rate approximately, right? You may remember we discussed
Okay,
real
1
rate
plus
we can
some.
calculate either. Yeah, approximately. Oh, what is the other method? We can calculate exactly. What is that method? That is called Fisher method. Fisher relation. You may remember we discussed how to calculate the real rate, right? So the point you mentioned, nominal rate minus inflation, that is correct, but that is approximate. That is the approximate relationship. But what is the exact real rate? That is what we call Fisher relation. You remember the Fisher relation, right? So what is the real rate? So how do you calculate? Right? You remember how we calculate that? Right? 1 plus nominal rate equal what? Equal. What is the method? 1 plus real rate. For the real rate, you may remember we use this I star into 1 plus, right? 1 plus expected inflation. Inflation means what? Change in the price level. Change in the price level. So this is the method we use to calculate the real rate. So then using this relationship, right? You know how to calculate the real rate. So how do you calculate the real rate, right? So this is the nominal rate, right? So how do you calculate the real rate? So real rate equal, right? So it is good to revise the point we have done earlier. It's actually, this is not a new concept. You all know this, right? So how do you calculate that? So real rate is equal, right? Real rate equal what? Real rate equal 1 plus nominal rate divided by, right? So how do you calculate? 1 plus nominal rate, 1 plus nominal rate divided by 1 plus price level, and from that you need to deduct what?
1.
Okay, so from this we need to deduct 1. So that is how we calculate the real rate. Okay, now calculate the real rate for this question. Calculate the real rate. Right, calculate the real rate for this example. Right, so you have all the information, so you can calculate the real rate. Right, calculate the real rate for this example. Right, so what nominal rate is given, inflation is given. Calculate the real rate. What is the real rate? Right, what is the real rate?
4.54%.
Right, so we'll use the decimal point as accurate as possible. You know, so if you put, if you mention, tell me a little bit more decimal points.
545.
545. Right, since we can calculate this very easily, so that's why I asked to give a little bit more decimal point. Right, so it is that means 4.545%. Right, that is the mean. Right, the rate is 4.545%. Right, so this is the real rate. This is the real rate, right? So that so the point you mentioned earlier, that is approximately 5%. Exactly, this is the value. Right now, this is the discount rate. This should be the discount rate. That means to calculate NPV here, we have to use 454, right, to the power 1, right? But you don't need to calculate this manually, right? So you can calculate much more easily than this, right? So much more easily you can calculate. So how do you calculate this, right? So you can calculate the NPV for this project very easily, right? So actually this is what you need to do. This is what you have to do. So when you calculate this way, you get the net percent, right? You get the net percent value when you calculate this way, right? What is the net percent value for this project? So, but you can calculate so easily using your financial calculator, right? So because last day we discussed how to calculate NPV using your financial calculator. Now all the cash flows are there to calculate. Even a little bit more decimal point you can mention. So 4.545 again it is 4. Right now, so you know how to calculate NPV, right? So calculate net percent value for this project now, right? So you know how to calculate, right? So use the cash button in your calculator, cash, right? Cash. Then you have to insert the discount rate. So that's why I mentioned even if you you get the real rate with so many decimal points, nothing to worry. You have to insert only once, right? So insert the discount rate in front of I. Okay. Then when it highlights CSH, press CXE and insert the cash flows, right? Even though we write the formula this way, what is the first cash flow you have to insert? When we write the formula, we put the formula in this way. But when you insert the cash flows to your calculator, what is the first figure you insert? Investment cost. That is minus 1,000, right? In front of 1, minus 1,000. Then 500, 500, 500. 3, 500 values should be inserted, right? Then press cash again and select NPV and solve. What is the net percent value? Okay, the calculation of NPV is so simple. Right, what is NPV?
$498.63.
498.
375.
3.
So would you mind repeating the
373.
steps, please?
361.
Yeah, so
373 times 30.
373.3, right? Okay, so that is NPV. The steps are these, right? Because I think is it right? Are you okay with the real rate calculation? The real rate is 4.5454. Right now, what you need to do, you in order to calculate NPV in your financial calculator, so you know you have to press this cash button, right? So press cash. When you press cash button, it highlight I, and so I mean the discount. For I, you have to insert this value 4.5454, right? Not with decimal point. Simply insert, right? Insert 4.5454, right? After that, you have to insert the cash flows, right? When we write the NPV formula, we write this way. But when you insert the cash flows to your calculator, right? We insert based on the timing. First of all, we have to insert the investment, right? So in front of 1, insert minus 1,000. In front of 1, insert minus 1,000, then EXE, 500 in front of 2, EXE, 500 in front of 3, EXE, 500 in front of 4, EXE. When there are 3 years, right, as we discussed, there will be 4 cash flows, right? And you get the NPV 373. Okay. And what is the method we use here? We use real cash flows and real required rate of return, right? So real cash flows and real required rate of return. So this is the method we use here, right? Is that clear?
So after the cash flow was inserted, how did you arrive at NPV from the cash?
after you insert cash flows, you have to press cash again. Press cash again. And then select, go down until you find NPV. Okay. When you insert all the cash flows, press the cash button again. When you press cash, then go down until it highlight NPV. When it highlight NPV, press the solve. You got the answer, right? Right. So it's 73.3. Right. So that here, what is the method we use? Real cash flows and real required rate of return. But we have another method. Right. We have another method. What is the other method? The other method, right? Here, what we did, we remove inflation from both cash flows and interest rate. The other method, we have to include inflation in both cash flows and discount. Right. So that way also we can calculate. Okay, we'll calculate that, right, using that method. Right, using that method also we can calculate. Right, we can use nominal cash flows. Nominal cash flows. You know, nominal means with inflation. Right. Now, in that case, what will be the cash flow for the first year? What is the cash flow for the first year? What is the cash flow for the first year?
500.
Sorry?
500 into 1.5.
1.1 because 500, this is the cash flow at constant prices if the price level did not change, but it is expected prices will change 10% per annum. Right, that means there is inflation. This is without inflation, constant. If the price level did not change, if the price level did not change, the cash flow for the first year will be 500. But if the price level change at 10%, what will be the cash flow? 500 will increase at 10%. That means what will be the cash flow for the first year? It will increase at 10% means what will be the value? The cash flow at the end of the first year will be 550. And in the second year, this will again increase at 10%. That means what is the value? Right, this will increase at 10%. That means the value will be 605. Right, because this also increased by 10%. Now 550 will increase by 10%. Okay, so it will be 605. And third year, this will increase again 665.5. Okay, that's correct. Right, so that will increase by another 10%, 665.5. And investment, it is the same amount because that is times 0. We don't need to adjust that. Now, what is the discount rate we have to use? These are which cash flows? These are which cash flows? These are nominal cash flows.
50.
Right? Why? Yeah, we have to use 15%. Right? If the cash flows are nominal, the required rate of return should be nominal. Right? Required rate of return should be nominal. So here we have to use nominal required rate of return. So it is 15%. Right, now when you calculate that way, what is the answer you get? Now you can calculate again. Right, only thing you have to change the cash flows and the discount rate. Again, go to cash, right, and insert the cash flows minus 1000, 550, 605, 665.5. What is the discount rate? Discount rate is 50. Right. So what is the method we use here? Nominal cash flows and nominal required rate of return. Nominal cash flows and nominal required rate of return. What is the answer? Same answer. You will get exactly the same answer. Right? That is right. That means you can see the effect of inflation on cash flows. Right? So the inflation, right? As we discussed earlier, also inflation we can adjust in two ways. Right? If you adjust correctly, if you adjust, consistently, whatever the method you use, you will get exactly the same answer. Right? Nothing to worry. So when you apply correctly, you will get the correct answer, whatever the method you use. Right? Either you need to adjust inflation to both cash flows and a discount rate, or you need to remove inflation from both cash flows and discount. Then you will get exactly the same. Okay. Right. Is that clear? Right. Okay. Then, right. So we can move to the detail project. So the questions we discussed so far. Right. The questions we discussed so far, all the questions we discussed, cash flow were given directly. It was given the investment. These are the net cash flow. Right. Only thing in one question, net cash flow before tax given. But again, right, only thing we had to do, we need to adjust tax. That's all. Right. Cash flows were directly given. Discount rate is given. So it's so easy to calculate these values. Right. But when we get a detailed question, right, the question will not be straightforward like that. Right, so you will get a very straightforward question like that in part A, right, for 10 marks. But in part B, you will get a detailed question. And not only for the exam, when you are evaluating a project, right, so it is necessary to evaluate it in detail, comprehensively, right, so that, okay, so when there is a comprehensive project, so in that case, it is better to categorize, specify cash flows, right? But you know one thing, it is not essential to follow this method, right? So classification of cash flow, even in this study text, it is not given this method. But you know, this is one good method. What that I saw in one good finance book. So which I think are very useful. And if you use this method, the possibility to make mistake is very minimal, right? Therefore, it's better to follow this, but not essential. Therefore, right, why I mentioned like that, because since you refer a lot of additional books, if you see some good method, right, so you can use that, no problem. But this is one good method that you can use. I'm sure you will not make a mistake, right? I'm sure you will not make a mistake, right? So this is one good method, right? We can categorize cash flows. When we are evaluating a comprehensive project, we can categorize cash flows into three main categories, right? When we are evaluating a project, what are the main categories at the time of starting the project, and during the period of the project, at the end of the project. So in this way, we can categorize the cash flows into three categories, right? So then cash flows we can categorize as at the time of starting the project. We call it initial investment outlay. Initial investment outlay. So this is the first category. The first category is initial investment outlay. Right. What are the possible cash flows under this category? Right. What are the possible cash flows under this category? Initial investment outlay. Right. What are the possible cash flows for this category? At the time of starting the project, what are the relevant cash flows when we are evaluating a project?
Capital investment.
Capital investment, right? So the most definite cash flow for this category is, we can call it fixed capital investment, right? We can call it fixed capital investment. Fixed capital investment, right? Fixed capital investment. So that this is definite cash flow, right? Definite cash flow, fixed capital investment. What else? That means new capital, fixed capital should be purchased. Maybe a company may have to build a factory, install machines, right? So that is what we call fixed capital investment. In addition to that, right? Sorry?
Sunk cost, will you put it in outlay? No.
No, sunk cost should not be considered. Sunk cost means what? So that should not be considered in project evaluation. So
the
if
outlay
that,
you
yeah?
The outlay you don't.
Yeah. So if there is sunk cost, so that should not be included. That of course we should consider, because there are certain costs like survey cost. Initially, certain amount should be incurred to identify whether the project is viable. But there can be certain cost after starting the project also. Continuously they have to do. In that case, it is relevant after starting the project. But after the starting of project, it is not relevant, right? So in addition to the fixed capital investment, right, what are the other standard cash flows we can see in this category? Normally, when you are starting a new project, what are the other relevant cash flows?
Your fixed
Possible cash,
will it come here, or your fixed overheads will it come here or later?
overhead, that means when the companies start, doing the project, right? Overhead expenses.
Yeah, yes, like you
Yeah,
have
that
to
is
commit
that is
on
during the
during
period of the
okay.
project. So that is under the second category. At the beginning, what are the other cash flows the company has to incur? Because normally, in addition to fixed capital,
Construction costs.
yeah. So construction, in fact, that also we include under the fixed capital construction, because when there is a factory, the construction cost also there. When if it is a machinery with installation charges, we have to consider, right? So that is everything fixed capital. In addition to fixed capital,
Preliminary
normally,
cost.
Project management.
sorry,
Preliminary
Project
cost.
management cost.
credit management, that's actually after starting project, right? So after starting
Project
project only, yeah.
Oh dear.
That is
Pre-development.
another common standard cash flow is there. That means after when the company is going to start a new project, there is another allocation they have to do in addition to fixed capital. What is the other one?
Working capital.
Working capital, right? The other almost the definite cash flow is working capital, right? So working capital, because for any new project, right? Any project, there should be working capital which should be allocated at the beginning, which can be recovered at the end, right? So working capital investment, right? So what are the other possible cash flows for new project? Sometimes for new project, the company may have to, so suppose company is going to buy a new machine, right? So then for that new machine, special training may be required. So some training cost may involve, right? So at the beginning, right? So training cost should be given to start the project, right? So there may be some training cost. What else? These are not common to all the projects, right? So these two almost certain all the capital investment. In addition to that, some projects may involve certain additional costs, additional cash flows. What are the other additional costs? Right. One thing is like training costs.
IDC.
What else? Sorry.
Regulatory payments.
Interest during
okay.
construction.
Yeah, that's correct. So for certain projects, maybe fees may be there, right? So some regulatory expenses may be there, regulatory payments. What else?
Consultation expenses.
Consultation expenses may be there, right? Consultation cost, right? Sometimes when the company is going to buy a new machinery, more advanced machinery, they may require less staff. That means what they have to do? They have to remove certain employees, right? So they may have to pay compensation. Oh, right? So they may have to pay. And sometimes if they buy new project, yeah.
The consultation cost. I mean, can't we think that as a sunk cost? Because you do consultation, everything. If the project doesn't come, then
okay. So there can be certain costs like that. Actually, consultation. This is here actually what I mean. It's not like a feasibility study. So if it is a feasibility study, that is definitely a sunk cost. Yeah. So design and so once the company is going to start the project. Even that survey cost, as you mentioned earlier, we have to see whether these are incremental or not. Whether this cost will be there even if the project. That means whether it is possible to change these costs, right? Recover or change, right? So that's why even that because I have seen in certain capital investment projects questions. So it's given survey costs should be incurred in this way at the beginning. So if the project started, there will be additional cost, right? Only that part is relevant. So consultation also we can consider that way. So if it is a consultation cost to identify whether the project is acceptable, then it is a sunk cost. So what you are mentioning is correct, right? Totally correct. And what are the other possible costs? What are the other possible costs? possible cash flows, right? Sometimes there can be a situation like this. If the company is going to, if the company buy a new machine, new assets, they can sell the old assets. Then there will be a relevant cost, right? Only if the company buy new assets, they can sell the old assets, right? Then there will be, in fact, all the points I mentioned so far, these are outflows, right? These are outflows, right? So if I put this way, right, these are outflows, right? These are outflows. Right, and if there is a if it is possible to sell, right, old assets, if the company buy new assets, there will be a cash inflow, right, due to the sale of old assets, right? Due to the sale of old assets, there will be inflow, right? Net cash inflows can be there, right? Cash inflows can be there. So these things, so these are the few examples, but there can be more, right? So these are some examples for this category, right? Usually the initial investment outlay, that will be a cash outflow, right? So there may be certain inflows, right? But mainly most of the cash flows included under this category will be outflows, right? And for all the projects, all these points may not be applicable, right? Only few examples, few cash flows may be applicable for different projects, right? Therefore, right, so we can calculate initial investment outlay this way, right? So when the details for a particular project is given, or when you are evaluating a project, you have to identify what are the cash flows which are incremental. Only the incremental cash flows should be considered. This is at the time of start in the project. The cash flows that should be incurred at time zero. And the second category is during the period of project, right? Usually this is the category that involves most of the calculation, right? But we discuss what are the points included here. So we call this annual after tax operating cash flow, right? Annual after tax operating cash flow. And usually this is the category that involves most of the calculation, right? So a lot of calculations will be included here, right? But the main points we already discussed. So this is how we calculate annual after tax operating cash flow, right? Annual after tax operating cash flow we calculate this way, right? So you remember we discussed last day, we have to consider cash revenue, and from that cash expenses should be deducted. Then we get net cash flow before tax. From the net cash flow before tax, we need to deduct depreciation. Then we get net profit before tax. From that we have to deduct tax. Then we get net profit after tax. We add back depreciation. We get net cash after tax, right? So this is the category that involves most of the calculations, right? Most of the calculations involves here. Details can be given in number of different ways. Sometimes this also will not be given directly, cash revenue and cash expense. Sometimes it may be given, this is the quantity the company is going to sell from the product they are going to produce. And this is the price they have estimated to sell the product. The quantity is given, price given. So you have to calculate the revenue, right? And this is the variable cost of producing the product. This is the fixed cost of producing the product. These are the overhead cost of producing the product. The details will be given. Then using that, we have to identify what are the relevant cash expenses, right? So that's why I mentioned. So even it looks very straightforward in this case, right? The details can be given in number of different ways, right? Sometimes marketing programs can be included in this category, right? So a lot of calculations will be there under this category, right? Annual after tax operating cash flow, right? And the third category, because this is the cash flow generated from the main operation. That's why it's called annual after-tax operating cash flow. Then the third category, that is once the project completed. Once the project completed, so that is called terminal year cash flow, right? So we can call it terminal year after tax, because we know all the cash flows we have used after tax. Terminal year after tax, non-operating cash flow, because these are not normal operating cash flows, right? So these are terminal year after tax non-operating cash flows, right? So what are the possible cash flows for this category? What are the relevant cash flows once the project completed, terminated? So this is at the time of starting the project, this is during the period of the project, and this is once the project completed, right? So what are the possible cash flows for this category?
Disposal of assets.
Disposal of assets, right? Because initially the fixed capital should be purchased, at the end the fixed capital can be sold, right? So disposed, right? And we call it right, so what is the term we use normally? We call it salvage. Okay, scrap value, that is also correct. Scrap value, salvage value. Another term is used, residual value, right? But that also we need to calculate after tax, because when the company is selling capital investment, sometimes there can be a profit, sometimes there can be a loss. Therefore, we have to calculate after tax salvage value, after tax salvage value. Usually, this include this involve several points to consider, right? Therefore, usually it's better to do a separate, small separate working for this to calculate the after tax salvage value, right? Why? So this we have to adjust tax. We have to adjust tax, right? So how do you calculate the after tax salvage value? First of all, we have to consider cost of the asset. We need to consider the cost of the asset. Then from the cost of the asset, what we need to do, right? From the cost of the asset, we need to deduct what? We have to deduct the total amount that has been depreciated so far. Accumulated depreciation. That's the correct term. So we have to deduct accumulated depreciation, right? Accumulated depreciation should be deducted. When we deduct the accumulated depreciation, then what is the answer we get?
Net book value.
Net book value. We get the net book value, right? The other term, written down value, right? So in accounts, you also call it written down value, right? Written down value or net book value. So we get the net book value. Net book value, also called written down, right? So when you deduct the accumulated depreciation from the cost of the asset, we get the net book value. When we get the net book value, that should be compared with the salvage, right? Expected selling price, right? So that should be compared with the selling price. Then we can identify whether there is a profit or loss, right? So we have to identify profit or loss on disposal, right? Profit or loss on disposal. Profit or if there is loss, that should be calculated on disposal. Because we know if the salvage value is more than the written down value, there will be a profit. If the salvage value is less, there will be loss. That should be calculated. Once we calculate the profit or loss, and we need to adjust tax. If there is a profit, then what will happen? There will be a tax on profit, right? The company has to pay, right? So company has to calculate tax on profit, tax on profit. And if there is a loss, what will happen? Right? We discussed last day. What will happen? Because when we are doing a project evaluation exercise, there is assumption we use, standard assumption we use. That means if there is a loss, what do we do? If there is a loss, what do we do? We calculate what? Tax saving on loss. Because this is only one project. This is only one project. We have to consider the tax saving, right? So tax saving on loss, right? So here I put both values, but there will be only one value when you are doing the real calculation. Tax saving on the loss, right? Because there will be either profit or a loss, right? But here I have mentioned both. If there is a profit, there will be a tax payment, right? If there is the profit, there will be a tax payment. But if there is a loss, there will be a tax saving, right? So that should be calculated. In fact, the purpose of doing this working is to calculate this value, this tax value. Then what we have to do, once we get the salvage value, right? Once we get the salvage value, right? The salvage value, we need to adjust this tax, right? So in fact, in this working, it might look like a little bit long working, but this is not difficult working. Here I have put all the possible conditions. That's why it's look like a little bit long working. Because once we calculate the salvage value, if there is a profit, what we need to do? To the salvage value, we need to add or we need to deduct?
Deduct
If
the
there is
tax.
a profit, we need to deduct, right? If there is a profit, we need to deduct the tax on profit. And if there is loss, we need to add back tax saving on loss, right? So if there is a profit, there will be a tax payment, so that should be deducted, right? That should be deducted. But if there is a loss, there will be tax saving that should be added to the salary. Then we get the after tax, right? Then we get this value, right? This after tax salvage value, that is, this is the value we have to use, right? So this is not a difficult adjustment, right? So here it looks like a little bit a long adjustment due to the point I mentioned earlier, because here I have put all the possible conditions. But when it comes to a real question, there will be only either profit or a loss, right? All these points will not be there, right? Therefore, so what we need to do, we have to consider what is the total, what is the cost of the asset. We need to deduct the accumulated depreciation. We calculate the net book value. The net book value should be compared with the salvage value. We have to identify whether there is a profit or loss. If there is a profit, company has to pay tax. If there is a loss, there will be tax, right? Then if there is profit, that tax on profit should be deducted from the salvage value. If there is a loss, tax saving on loss should be added to the salvage. Then we get the after tax salvage, right? What else? What are the other possible cash flows? Other possible cash flows?
Any compensation?
Any compensation? Sometimes the company may have to remove certain employees compensation, or right? So company may have to pay. That should be adjusted. Compensation, right? What else? So that will be a cash outflow. That will be a cash outflow. What else?
Any statutory balance payments?
Yeah, so if there are any statutory payments, right, and some maybe cleaning and clearing of sites, so that should be incurred, right? Statutory payments. If there is any statutory payments, right, and that is another standard cash flow we can see in this category, right? Once the right at the point of starting the project, what are the cash flows? So and while and the point of closing the project, what are the cash flows, right? So fixed capital should be purchased at the beginning and can be sold at the end, right? What are the other standard cash flows? There is another cash flows which is almost standard cash flow for project evaluation. What is that?
Balance
Working capital.
Working capital can be recovered because when right initially certain amount should be allocated. At the end it can be recovered. Recovery of working capital, right? So recovery of working capital. Recovery of net working capital. So that is another inflow, right? And there may be some compensation, statutory, right? Other fees. Any other possible cash flows? Right. So those are the main cash flows, right? So actually, the final value, whether it is a positive or negative, depends on the relative strengths of the other figures. Because usually this category has a negative value, this will have a positive value, and the final figure of this category depends on the relative strengths of this cash flow. Sometimes if there are significant compensation or statutory payment, this will be negative, right? But if the salvage value is significant, then this will be positive, right? So so these are the three main categories. Actually, this is a good method, right? So because when you get the details of a project, when you are evaluating a project, So you can easily and very logically analyze the project if you do this way. Because when you do this way, if any value is missing, you can identify, right? You can identify it. And so that the point I mentioned earlier, the possibility to make mistake is very, right? You will not make a mistake. So that's a good method. This is one good method. But as I mentioned, but it is not essential. If you are more familiar with some other method, you can use, no problem. Whatever the method you use, finally you will get the same answer if you calculate correctly. Okay, so these are the three main categories, right? So we can discuss the question at the end of the chapter. Maybe we can take a break. We'll take a break, and after that we'll discuss some questions at the end of this chapter. Right? Any questions for taking the break?
That when you calculate that opportunity cost,
Yeah.
If you, I mean, you said do you take the value of that opportunity cost and deduct that from the initially outlay? I mean, will you deduct on these cash flows?
Yeah, actually, opportunity cost can affect a number of different ways. Because opportunity cost, we can't say. That means before we get the correct information about the project, we can't say what is the impact of opportunity cost. Opportunity cost, as you mentioned, sometimes it can affect to the initial outlay. Sometimes it can affect to the period of the project, right? For example, if the company has a building, as I mentioned earlier, so if they are going to use this building, then for the entire period of the project, company has opportunity, right? So that means for period they lose the renting, then what will happen? That opportunity cost, right? So therefore, this depends on the nature of the project, right? Sometimes,
for example, so if
right?
there is
therefore,
a,
okay, that's yeah.
There is a opportunity cost on rent. For example, we say they are using the own building and the space, but they can rent it out. In that case, will they take the value of that and you have to deduct it from the initial outlay?
Not initial outlay. That means they are losing. Yeah, they are losing the rent income.
On your net calculation, you can deduct.
Sorry.
On your net cash flow, you can deduct that.
Yeah. Okay. That's another important point. What is the category that you can adjust? So now it is better to categorize into these three categories. Now in that case, right? So that is not relevant for all three categories. That means if there is a special factor like that, so it is possible to adjust that separately, because that will not directly affect to the initial outlay. That is not the operating cash flow. It is not a terminal year cash flow, but that is a cash flow which affect the entire period of the project. So opportunity cost, it is always better to adjust separately. It is better to adjust separately, but that means you will get the same answer even if you include under the annual operating cash. But it is not operating cash flow logically. So that's why when you are doing the analysis, if you put that separately, then it is much more clear. You can see the impact of that to the analysis also, right? Therefore, right, so it's very important you mentioned that point here. So opportunity cost, it is better to adjust it separate, unless it directly affects into the initial outlay, we can adjust here, right? If it directly affects into the terminal year, we can adjust here, right? But right, if it is not operating cash flow, but if it affect the entire period of the project, better to adjust it separate. But
in that case, when you're adjusting separately, that also will you discount it according?
Yes. That means once we include the opportunity cost, right? That means then only we calculate the net cash flow, right? So after considering the cash flows relevant for all three categories, then only we calculate the cash flow.
Okay, right. Okay.
Yeah, so in fact, the point you mentioned, there are some good questions in this book. So when you do that, so you will see that because net cash flow, the final value we calculate considering all these points.
Yeah.
Right. Okay. Then any other question? Right. Okay. Then so let's take a break, and after that, so we'll discuss the question at the end of this chapter.
Time is running fast.
Right. Okay, shall we start?
Yes.
Okay. Yes.
Right. Okay. Then these are the main factors we have to consider, and then so we, as we discussed, better to categorize into these categories. Right? One. Right. Right. So then we can discuss the question at the end of this chapter. So before we discuss the self-study problem, question under the self-study problem, first of all, we'll do the question under the problem solving exercises, because there actually the questions have been given for these different parts of the capital investment appraisal analysis study. Right? Then we can do that part first. After that, we'll move to a comprehensive question. Right. So if you move to the page number 154, the question in page number 154. Question in page number 154 under the problem solving exercises. Okay, page number 154. Right. So this question. 4 and 6 stores private limited. Right. Right. So there are the question is that the 4 and 6 stores private limited is considering locating another outlet in an eastern suburb of Melbourne. Estimates of sales and operating expenses have been calculated, and an estimated profit and loss statement for the new store drawn up. The profit and loss statement for year 1 is thought to be representative of each of the 10 years of the expected life of 4 and 6 stores. The initial outlay to construct the store is 400,000, while the outlay necessary to stock the store is 20,000. The estimated profit and loss statement for the new store for year 1 is shown in the following table. Right, there are the details given: revenue less sales return, then operating expenses under the operating given, and the profit after tax given. Estimate the project annual cash flow. Right, the question is estimate the project's annual cash flow. Right, actually in that question, even though these initial details are given, so that is not relevant here. So here we don't need to calculate NPV or other values, because discount rate or those things are not given. We have to calculate the estimated annual cash flow. That means actually this second category. Right, so the points we discuss, according to the points we discuss, what we need to do, we have to calculate this annual cash flow. Right, annual cash flow, that means this second category we discuss. So this is what we have to do. Right, so the in question, right, so this is question in page number 154. Right, so what we need to calculate is the annual cash flow. That means after tax, annual after tax operating cash flow. Right, so this initial information not necessary for this question. Right, okay, so from this profit and loss statement, the given estimated profit and loss statement, we have to calculate what is the annual after tax operating cash flow. Right, what is the after tax operating cash flow, right? That means net cash flow after tax. This is what we have to calculate, right? Then we have to use the relevant information from this estimated P&L account, right? So for the revenue, what is the relevant value we have to use here? Revenue, what is the relevant value we have to use? Revenue, we have to use which value?
360.
360,000, right? So we have to use net revenue, right? Net revenue 360,000, right? So it is 360,000. Right. Then from that we need to deduct the relevant expenses, right? So what are the expenses? What are the relevant expenses? Cost of goods sold. Is that relevant? Cost of goods sold, is it relevant?
Yes.
Yes. Right. Cost of goods sold, that is relevant, right? Cost of goods, right? So that is relevant. So we need to deduct that, right? What is the cost of sold? 160,000, right? 160,000, right? Administration cost. Is it relevant? Right? Administration cost, that is also relevant cost. Administration cost, right? So that is relevant. So that also we need to deduct. What is the amount? 60,000. Actually, that is not relevant to calculate the net cash flow before tax. But when we calculate the net cash flow after tax, that is relevant. So we'll right. But we know we have to calculate adjust that after calculating the net cash flow before tax. Right. And then what about interest? Interest, is it a relevant cost? So we should deduct or we should not deduct interest cost?
Not deduct.
Sorry.
Not deduct.
Not deducting. We should not deduct, because that's why we discussed earlier. Finance cost is not deducted when we calculate net cash flows because we discount, right? So therefore, we don't deduct finance cost, interest cost when we calculate the net cash flow, right? Therefore, these are the values we need to deduct. Then we can calculate the net cash flow before tax, right? So when we deduct this, we get net cash flow before tax, right? So what is the net cash flow before tax? 306,000 minus 160,000 minus 60,000, that is
140.
140, right? So 140, and that is the net cash flow before tax. After that, what we need to do? We should deduct depreciation, right? So now we need to deduct depreciation. Depreciation we deduct. Depreciation value is 36,000. When we deduct depreciation, then what is the answer we get? We get net profit before tax, right? So we get net profit before tax, right? What is the net profit before tax? That is 104,000, right? 104,000. And from that, we need to deduct tax, right? We have to calculate tax based on the net profit before tax, right? So we have to calculate tax. What is the tax rate? The tax rate is 39%. So we have to calculate tax at 39%. Tax at 39%. That is right. So we have to calculate 39% of 104,000. That is 39% of 104,000. That is right. So it's better if you
40.56.
Yeah.
40.56.
Yeah, 40,560. 40,500.
To calculate the tax component, don't you deduct the interest also at this time?
No. Interest we should not deduct. Interest we don't deduct, right? Actually, when you calculate the cost of capital, what is the cost of capital we calculate? For the cost of capital, we adjust tax, right? Cost of capital,
Yeah. What I have to calculate the tax component.
Yeah. So even tax we adjust to the cost of capital, because when we calculate the cost of capital discount rate, we calculate the after tax cost of capital.
Oh, okay.
Right. So then, so when you deduct tax, then you get net profit after tax, right? You get net profit after tax, right? So here, net profit before tax we got earlier, and based on that, you calculated the tax, and then when you deduct tax, you calculate net profit after tax, right? So net profit after tax, right? What is the net profit after tax? The net profit after tax is 63,440, right? Is that correct? Right. That is the net profit after tax, right? Then what we need to do? Right, what we have to calculate the net cash flow, right? Net cash flow. Then we have to add back
Depreciation.
right? We have to
Depreciation.
add depreciation, right? When you add back depreciation, that is 36,000 you need to add, and when you add depreciation, then you get net cash flow after tax. We need to calculate what is the annual cash flow. The net cash flow after tax is 99,440, right? So based on the information given, so we can easily calculate the net cash flow after tax, right?
So here, as per this, you mean to say that net cash flow before tax is equal to net profit before tax?
No, no. Net cash flow after tax and net profit before tax, that's different. So here net profit before.
Yeah. Net cash flow before tax. From that, deducting the depreciation, then you are saying net profit before tax.
Yes. Because here we have considered only cash expense, cash revenue and cash expense, right? Then we get net cash flow before tax.
Yeah.
From the net cash flow, we can deduct non-cash expenses which are tax allowable. That's why we deduct depreciation, which is a tax allowable expense. Right? Actually, in tax terminology, we call it capital allowance, right?
Yeah.
So which is the the tax benefit on depreciation. So when you deduct depreciation, that is the value you have to pay tax. That's why net profit before tax, and the tax should be calculated based on that. That means the benefit we get from depreciation, we have adjusted, right? Then once we get the net profit after tax, but we need net cash flow after tax because project evaluation analysis based on cash flows, right? That's why we discussed earlier the purpose of deducting depreciation here and we adding back here, right? That is to adjust the tax benefit, right? So purely to adjust the tax benefit on depreciation, right?
But still, when you say net profit, you should deduct interest portion as well, right? Finance cost as well, right? So in this case, of course, you don't have to. But in normal case, net profit before tax, that means you have to deduct interest. Is it correct to use net profit before tax, after tax here? That terminology.
Yeah, actually,
is it KD? What are you referring to?
Sorry?
KD?
Sorry?
Indira, Hari, okay, my doubt is clear, Indira, no, because I had a small doubt. That's okay, done.
Yeah, actually, this is these terms we use for project evaluation purpose, right? So as you, right, I think the point, the information that is true. This is for financial accounting purpose. This is not the net profit, right? Because financial accounting, that is based on actual historical information. This is for project evaluation technique based on estimated value. This is entirely estimated value, but in financial accounting, there is no time value money adjustment. So so completely based on historical information, right? So that's why so here this net profit and the net profit as per the annual report will be different. Definitely for the even if the estimates are perfectly correct, the for the financial accounting purpose it will be different, right? Okay, so then so that is how we calculate the net cash flow after tax. This is the annual cash flow, right? Then we can move to question number 2. in page number 155. Right, question number 2. Right. So let's do the question number 2 in page number 155. All Night Coffee Shops Limited is a successful, profitable company. Right, successful, profitable company, which operates several dozen coffee shops throughout the metropolitan area of Melbourne. However, the shop in the suburb of Burnaby has not been well patronized, generating a before-tax cash inflow of only $5,000 in the past year. The Burnaby shop began trading 2 years ago in premises leased from CBD Limited. The lease is about to expire and All Night will not renew it. The competitor, Brazil Coffee Shops Limited, has offered to buy the fixtures, fittings and equipment in the Burnaby shop for $40,000. All Night has agreed to this figure, even though this is $30,000 less than the cost of the fixtures, fittings and equipment 2 years ago. Assume that for tax purposes, fixtures, fittings and equipment were depreciated at 10% per annum straight line method. That the company's tax rate is 39 cents. Calculate the net cash flow generated from the sale of the items. Right. So that is what we have to calculate. In fact, based on the points we discussed earlier, what is the value we have to calculate? We have to calculate after tax salvage. Right. So this question. That is the third category. You know, one main item under the third category, terminally a cash flow, but in the after tax salvage value. So that is what we have to calculate, after tax salvage value. We already discussed how to calculate the after tax salvage. Because in order to calculate the after tax salvage value, we have to see whether this company is going to sell this these assets at a profit or at a loss. Right? Then the tax should be adjusted. Right. So first of all, we have to identify the cost of these assets, right? What are the assets? The assets here, fixtures, fittings, and equipment, right? So we have to identify cost of these fixtures, fittings, and equipment, right? Cost of the fixtures, fittings, and equipment, right? What is the cost of these fixtures, fittings, and equipment? What is the cost of these? 70,000, right? 70,000. So how do you get that value? Because it's not given directly, but very clearly information given to calculate to identify the cost of these assets, right? Because it's given clearly, they are going to sell, right? They have received the offer for this asset, right? It was given All Night. Sorry, a competitor, Brazil Coffee Shops Limited, has offered to buy the fixtures, fittings, and equipment in the Burnaby shop for 40,000. All Night has agreed to this figure, even though it is 30,000 less than the cost. Yeah, right? They have got to offer for 40,000. They have agreed, even if it is 30,000 less than the cost. That means the cost is 70,000. Right? Then from that we need to deduct what?
Accumulated depreciation.
Accumulated depreciation. Total amount that has been depreciated so far. Right? Accumulated depreciation. We need to deduct accumulated depreciation. Accumulated depreciation, right? So what is the accumulated depreciation? Because here 14. The depreciation policy is given very clear. Depreciation rate is 10%, policy is straight line. So simple. That means accumulated depreciation is 14,000, right? 14,000, because 10% per annum, 2 years, right? 10% per annum, 2 years. So simple. So accumulated depreciation is 14,000. Then you can get the net book value, right? What is the net book value?
56.
Net book value is 56,000, right? The net book value of this asset is 56,000, right? That should be compared with the expected selling price, right? Then we can see whether there is a profit or loss, right? What is the result? There is a profit or loss. There is a loss. There is a loss, right? Loss on sale, loss on disposal, right? What is the loss? That is what is the loss?
16,000.
16,000. There is a 16,000 loss, right? Why? The assets with the net book value of 56,000, they have to sell at 40,000. That is a loss of 16,000, If there is a loss, what is the impact? There will be a tax
saving.
There will be a tax saving, right? So we have to calculate tax saving on loss. Tax saving on loss, we have to calculate. What is the tax saving on loss? And the tax rate is given 39%. So tax saving tax saving on loss at 39%. So we can right. So we can calculate what is the tax saving. 39% of
6,000.
6,000.
6,240.
Yeah, 6,240. 6,240. Right. So that is the tax saving on loss. Then what we need to do, the salvage value is given, right? Salvage value is given. Salvage value is 40,000, and to the 40,000, what we have to do, we need to add ODIDA. We have to. We need to add.
Salvage value is,
tax saving. We need to add, right? Because that is a tax saving. That is similar to inflow to the company, tax saving, right? Tax saving.
Yeah.
Tax saving on loss, we need to add. So tax saving on loss is 6,240, and when you add that, you get the after tax salvage value, right? After tax salvage value. Okay, so that's easy to calculate the after tax salvage. Right. Right. So now, that's why I mentioned it's better to do these two questions first, because in these two questions you can see several parts, right, of this project evaluation exercise has been analyzed separately. Now, so it's very clear how to calculate the after-tax salvage value, how to calculate the annual after-tax operating cash flow. Now it is possible to do a comprehensive question, right? A question with all the details can be done, right, easily, right? So here there is a small question as point 3 in the same section, but I think we can discuss the detailed question in under the self-study problem in page number 153, right? So I think we can do the detailed question, right? So if time permits, we'll do the last question also, but otherwise you can do that small question later when we discuss this detailed question now, right? So we'll discuss the detailed question in page number 153. Question in page number 153, right? Detailed question is, we'll do that. Right. Okay. So in page number 153, comprehensive detailed question is there. So usually for the exam, you get a detailed question like this. That's why when you practice question like this, you can get 15 marks so easily, right? That's very simple to get these marks. But only thing in this question, right? The main thing in this question is the management of time management, right? Because it's a simple question, but that has number of calculation. Therefore, it is so important to practice, right? So let's do this question, right? Before that, if you have any question, you can ask. Right. So let's do the question in page number 153. Right. Okay. So page number 153, you will have the study text, right? The Frank Stone Company, I think I don't want to share the study text since you will have that. So in page number 153, so I'm referring to this question. I'm referring to this question in page number 153. The Frank Stone Company is considering the introduction of a new product. Generally, the company's products have a life of about 5 years, after which they are deleted from the range of products the company sells. The new product requires the purchase of new machinery costing 400,000 including freight and installation charges. Useful life of the equipment 57,500. At the end of that period, the machinery will be depreciated for tax purposes by the reduce in balance method. The machinery will be depreciated for tax purposes by the reduce in balance method at a rate of 15% on book value. Reduce in balance method. You know, reduce in balance method, right? Then the new product will be manufactured in a factory which is already owned by the company. The factory originally cost 150,000 to build and has a current resale value of 350,000, which should remain fairly stable over the next 5 years. The factory is currently being rented to another company under a lease agreement, which has 5 years to run and which provides for an annual rental of 15,000. Under the lease agreement, if the Frank Stone Company wishes to cancel the lease, it can do so by paying the lessee compensation equal to 1 year's rental payment. This amount is not deductible for income tax purposes. It is anticipated that the product will involve the company in sales promotion expenditure, which will amount to 50,000 during the first year the product is on the market. The full amount is deductible for tax purposes in the year in which the expenditure incurred. The addition to current assets will require 22,500 at the commencement of the project and assumed to be fully recoverable at the end of the 5th year. The new product is expected to generate operating net cash inflows before depreciation and income tax as follows, right? For the 5 years, details are given. It is assumed that all cash inflows are received at the end of each year, and that income tax is paid at the end of the year in which the inflow occurs. The company income tax rate is 39 cents in the dollar, and the company has a required rate of return of 10% after tax. Right. Then the printing mistake, you can write the next point, calculate NPV, IRR, and payback period. Otherwise, there is nothing to do. Okay, so please note down, calculate NPV, IRR, and payback period. Right. Okay, so let's do this question.
Calculate NPV, IRR, and
Payback period, PBP, payback period. Right. Okay. So this particular project has a period of 5 years, and we can see the cash flows also not equal for all the years. Therefore, we need separate columns for this project. So, which means you have to include so different 6 columns, because you have to include one column for year 0 also. Include the 6 column for each year, right? So you have to include the column for each year. Now, right, so let's calculate this, right? So I think it's better if you all calculate this. Right. Since we read the entire question, right, now, right, so we know what are the key points. The best thing, when you insert the cash flows to this question, will follow the method I mentioned, right? So later, if you want, you can change that. But so we'll do this way. So what are the 3 categories I mentioned? Initial, investment, outlay. We'll start with the initial investment outlay, right? So I hope you will calculate this, because the important thing for this question is practice. So you have to calculate initial investment outlay. Right. Now, okay, what are the cash flows relevant for this category, for this project? Right. So we read the entire question, but now from the beginning, the relevant part we can read, right? Because we have some idea about this question now. Since we read the entire question, now we'll see what are the relevant points. Initial investment outlay, right? So we know what are the main cash flows that should be included. Right. We saw at the beginning, the new product requires the purchase of a new machine. New machine. Right. So definitely that is a relevant fixed capital investment. New machine. Right. New machine. Right. What is the amount? 400,000. And since it is investment, so which means it's a cash outflow. Right. It's a cash outflow. Right. Therefore, we have to include as a minus value within bracket, right? New machine, right? Then salvage value is given, so we'll adjust that later, right? So we know that is included under the third category, terminally cash flow. Expected selling price is given. The depreciation is given, we'll adjust that under right when you calculate the tax, right? So we know we have to adjust that under those sections, right? Then the next point. The new product will manufactured in a factory which is already owned by the company. The factory originally cost 150,000. Right. What is the relevant point for this question? Right. What is the amount we have to use here?
No.
No, it is not relevant. Why? The factory originally already constructed. So this 150,000, that is not a relevant cost. It is not incremental because factory already constructed. 150,000 we should not use here. Right. So whether this project started or not, the factory is there. Right. So this building is there. Right. This factory is there. Therefore, 150,000 is not relevant. And the current resale value is 350,000. 350,000. Is it relevant?
No.
No, that is also not relevant. Whether this project is there or not, if they want, they can sell. Right. Which should remain fairly stable over the next 5 years. The factory currently being rented to another company under lease agreement, which has 5 years run and which provide for annual rental of 15,000. Is there something relevant here?
This is opportunity
Cancellation is relevant.
Yeah, so here 15,000 under the lease agreement. If the Frankstone company wishes to cancel the lease, it can do so by paying the lessee compensation. Compensation is relevant. Only compensation? Oh, only compensation?
Yes.
Is relevant?
For this only
Yes.
compensation, the lease is for the operating.
Yeah, and in addition to that, opportunity cost is there. Right? There is no cash outflow, but there is opportunity cost. Right? Why? If they cancel the lease, what will happen for the next 5 years? They will not get this rent income. Right? Therefore, there are two relevant points here. One thing is they have to pay compensation today, and for the next 5 years they are losing the rent income. Right? Therefore, two relevant points. The compensation you have to include under this category because that should be paid to start the project. That means that is under the initial investment outlay. What is the amount? What is it? Yeah, 15,000.
1 year payment.
1 year payment, that is 15,000. Right? So 15,000 compensation should be paid. Right? And we should remember, right, as you mentioned, there is an opportunity cost which will affect to period. All 5 years. Because for the next 5 years, they are losing lending. Right? That will adjust later. Right? Right. Okay. Compensation should be paid to start the project. Right. What else? Anything else under the first category?
Yeah, there's a 22,500.
Exactly. Right. Because here there is a current asset. That means working capital. Right. Investment in current assets. Working capital. Right. Working capital investment. Working capital 22,500. Right. Okay. Right. Anything? Is there anything else related to the initial investment outlay?
That's all.
That's all. That's all. Right. So under the initial investment outlay, right, you can see it's not difficult. It's not difficult at all. Right. So when you read the question, properly, you can identify what are the relevant points. Right. So that's why I mentioned this method. Very good method. Right. And you will not miss anything. So definitely you can do the calculation perfectly correct. Right. Then we can move to the second category, annual after tax operating cash flow. Right. Annual after tax operating cash flow. Annual after tax operating cash flow. Right. Okay. So that so this in this question it's fairly easy, right? Why? Net cash flow, net operating cash flow before tax given directly. right? So you know when the net operating cash flow before tax is given, you know how to calculate net operating cash flow, net cash flow after tax, right? So net operating cash flow, right? Right. Let's say okay, net operating cash flow before tax given, net operating cash flow before tax given, right? The values are given, so you can put under the for the relevant years. First year 200,000, second year 250,000, third year 325,000, fourth year 300,000, and fifth year 150,000. Okay, net operating cash flow before tax given, right? Then, right, but we know we have to use net cash flow after tax, right? We know the method of calculating cash flow after tax when the cash flow before tax given, right? So what you have to do?
Deduct depreciation.
You deduct depreciation, you get net profit, then you calculate net profit before tax, you deduct tax, you get net profit after tax, you add back depreciation, you get net cash flow after tax, right? But in this question, in addition to that, is there anything else to adjust?
Yeah, 50,000 first year sales and promotion expense.
Yeah, there is one more point. One more point is there, right? So that's why it's important to read the entire question, right? So otherwise, you have to change a couple of several balances, right? Here, 50,000 sales promotion expenditure is there during the first year, right? Therefore, that we have to adjust for the first year, because it is given it is tax deductible, right? Sales promotion expenses. Sales promotion expenses. Sales promotion expenses, that is for the first year, right? What is the amount? 50,000. Right. So that is only for the first year, right? Only for the first year, right? Then we can use our
15,000.
normal. Sorry.
That lease.
Yeah. Opportunity cost. That's why I mentioned earlier. Better to adjust the opportunity cost separate. Then there is no confusion because opportunity cost, that is not operating cash flow. So even if you include here, you will get the answer, same answer. But that is not logically correct. It is not an operating cash flow.
Classification is not.
Yeah, classification is not very correct, right? Otherwise, even if you put that here, so that will be okay, right? But let's do it in the better way. So we'll adjust that later, right? So we'll put separately opportunity cost. Right
So
now,
if you put that there, it will be wrong, right? Once you compute the tax.
yeah, because right, okay, that's very important point, right? So because when you compute tax, it is it will affect to the tax also. But even when we calculate the opportunity cost, which value we have to use, if the company receive rent income, what will happen, right? So that's a very good point you mentioned, right? So if we want to adjust the opportunity cost, right? So what is the relevant amount there? If this if the company
After tax.
that also we have to use after tax, right? Right. Actually, those are the important things, right? Rather than just put in the figures, those things should be we have to analyze with the correct understanding. That's really good, right? Because that's a very good point. Even when we calculate the opportunity cost, right, what will happen if the company receive rent income, they have to pay tax on that. Therefore, when you adjust opportunity cost, what is the rent income we have to use? Rent income after tax, right? Rent income after tax. So that's why. So even if you put that rent income here, when you calculate tax, that will be adjusted, right? Really good, right? Okay. Then so we need to deduct depreciation. Right, depreciation. Right. What is the depreciation here? Right. Okay. So here it is given. Right. Better to do separate calculation here because the depreciation policy. What is the depreciation policy?
Reducing down balance.
Reducing balance method means right? The depreciation is calculated on book value, net book value, not on cost. Then what will happen? The depreciation expense change. It reduce, as the term implies, reduce imbalance. Right. So better to do a separate small working. Then it will be more clear. right? So we know for the first year, of course, it is what is the cost? Because the first year depreciation is based on cost, right? Because it's not depreciated when it is calculated for the first year, right? Right. So what is the first year? First year depreciation. First year depreciation is depreciation rate is
60,000.
Yeah, depreciation rate is 15%. That means 60,000, right? As you correctly mentioned, it is 60,000, right? So the depreciation for the first year will be 60,000, and we'll do this working first. Then it is easy to put the figures here, because at the end of the first year, what is the net book value? The net book value is 340,000, right? Then for the second year, what is the depreciation?
Again 15%.
Again 15%. 15% on
340.
340,000, right? That means what is the depreciation expense? The depreciation expense is
51.
sorry, 51,000. It is 51,000, right? The depreciation expense is 51,000, and then the net book value after the after second year is what is the net book value?
289.
289,000, right? 289,000. Then third year depreciation will be 15%.
43,350.
Yeah, 43,350, right? So that is 15% on 289,000, right? Then so you can calculate the net book value for the at the end of the third year. That is
240/650.
245,650, right? Then for the fourth year, you can calculate depreciation for the fourth year. That is 15% of 245,650. That is
36,847.50.
okay. So 36,847.50. We'll use 36,848, right? So 36,848, and net book value at the end of the fourth year is
208,802.
right? Then we can calculate the depreciation for the fifth year.
802.
Yeah, so we'll use 802, right? Okay, 36. Right, 802. Right, then and based on that, you can calculate the depreciation for the fifth year. That is depreciation for the fifth year is 31,320, right? 31,320, right? Okay, so these are the values we need. These are the values we need, which means okay. So you calculate the depreciation for all 5 years. Now it is easy. We can put the values here. First year 60,000. Second year 51,000. Third year 43,350. Fourth year 36,848. And fifth year 31,320. Right? Okay. And when you deduct these values, then what is the answer you get? Then you get net, right? So here we directly get net profit before tax, and we get net profit before tax. Right? You know how to calculate these values now, right? So one good method to calculate this, right? You know, when you deduct these values, you get net profit before tax. After that, what you need to do? You need to deduct tax. You need to deduct tax. What is the tax rate? Tax rate is given.
39%.
39%. 39%.
39%.
Yeah, 39%.
39.
39, yeah, 39%. So we have to calculate tax at 39%. Then we get net profit after tax, right? We get net profit after tax. When you get the net profit after tax, then what you have to do? You need to add depreciation. You have to add depreciation. You have to add depreciation. When you add depreciation, then what is the value you get? You get net operating cash flow after tax, right? You get net operating cash flow after tax, right? So one good method, so you can follow, right? Because in the exam, I mentioned the main thing in this question is the ability to calculate quickly, right? So here you can see there is nothing difficult in this question. Only thing, it takes time, right? Because here the best thing, without using, you can't use Excel in the exam, otherwise this is easy, so easy. But in the exam you have to calculate this manually, right? So one good method to calculate this, you when you get the net profit before tax for a particular year, do calculation up to the net profit net cash flow after tax for the same year, then you move to the other year, then it is much quicker. You can calculate, right, very quickly the value for, right, net cash flow after tax for all 5 years, right?
Sir, one more thing. Now it is given that after 5 years, the salvage value of the asset.
Yeah. So that we adjust in the third category, because here,
Yeah. Right. Okay.
so this is actually annual, right? So that is the third category. The third category, the cash flows we have include
Adjust.
still, right? Okay, now
Normally, when we make the depreciation, don't we deduct back salvage value and do the depreciation?
Yeah, that's what I
no,
was thinking.
because you are referring to that. So actually, salvage value we adjust for what? When the straight line depreciation method is, right? Because salvage value we don't consider when you calculate the reduce imbalance method. When you use the reduce imbalance method, in fact, the salvage value that actually another point. So in financial accounting, salvage value, and here that is two different things. So because in financial accounting, salvage value we deduct when the rate is not given. So because in order to calculate the depreciation, you have two main methods. One thing, either depreciation rate should be given, otherwise useful life should be given. If the depreciation rate is given, you directly adjust the depreciation rate to the, right? If it is straight line method, you adjust the depreciation rate to the cost. If it is reduce imbalance method, you adjust the depreciation rate to the net book value, right? If the rate is given. The other method, when the useful life is given. If the useful life is given, then it is necessary to use the salvage value. If that method is used, how do you calculate the depreciation expense? Using the reduce imbalance, using the straight line method. Expense equal cost minus salvage value divided by useful life, right? But that is based on the straight line method. When you use the reduce imbalance method, how do you adjust that? Actually, when reduce imbalance method is used, right? So rate should be given. If the rate is not given, if the salvage value, only the salvage value is given, how do you calculate that? There is a formula, right? There is a formula to calculate the rate first, because it is essential to calculate the rate first, right? So when you are doing financial accounting, you may have done that, right? So there is a formula to calculate the depreciation rate when the reduce imbalance method policy is applicable. There, first of all, we have to calculate the depreciation rate, right? For that, there is a special formula, residual value divided by the cost of the asset, root sign divide, to the useful life of the asset, right? That's fairly detailed formula, right? I think I had that formula, right? I know how to calculate that, right? But so that is not expected here. That is not expected here.
So then, sir, are we considering this under non-operating cash flow as a income, okay, as a cash flow
Sorry?
in no, then this, since we are not taking this salvage value,
Yeah.
are we taking that under non-operating cash flow to consider
No, salvage value we adjust under the terminal year
operating?
cash flow.
Okay.
Right, terminal year cash flow, right? We adjust there, right? So now can you see this material? Yeah,
Yes.
yeah. So here, when the reduced imbalance method is used, this formula we use to calculate the rate of depreciation. This is actually some other notes I use for financial accounting lecture, right? So this is how we calculate the, we adjust the salvage value to calculate the rate of depreciation under the reduced imbalance method. Because otherwise, to calculate the depreciation, so this is how we calculate the annual depreciation charge based on straight line method. Cost minus residual value divided by useful life. Right? This is financial accounting adjustment. Right? Otherwise, when the reduced imbalance method is applicable, we calculate the rate like this: 1 minus residual value divided by cost of the asset to the root sign we have to use with the useful life. And this is not a difficult calculation. So even though formula looks like a bit complicated, with any scientific calculator, you need only 1 minute to calculate this, right? But for that, we need the useful life, right? But this is for financial accounting purpose, right? But here, salvage value we are going to adjust. We are going to adjust, and don't worry, right? But we need to adjust the salvage value under the terminal year cash, right? Because here you can see depreciation we adjust. When we calculate the when we adjust the depreciation here, we calculate the depreciation based on the reduced imbalance method, right? We calculate the depreciation based on the reduced imbalance method, and so after that, under the terminal year cash flow, we'll adjust the salvage value, right? So don't worry. Right. So let's do this calculation. Right now, so you need to do this calculation quickly, right? Okay. Since we don't have much time, so I will put these figures. So today, right? Maybe you can do the calculation. Right. So we have to calculate the tax value here, right? Which is 39% of this, right? And then you get the after tax profit. Then you need to add back depreciation, right? Then so you need to get the total of these two, right? So what is the net operating cash flow for the first year? 140,000. Right. So this is the value. So that calculation you have to do for all 5 years, right? So you will get this one, right? So please check whether these are correct when you calculate, right? When you calculate this, right here, from the right, so from the net profit before tax, you calculate the tax at 39%. When you get the profit after tax, you add back depreciation, you get net operating cash flow after tax. Then the terminal year, right, cash flow we have to include here, right? So terminal year, non-operating cash flow, right? This we need to include, right? What are the terminal year cash flows here? Right. So in this question, what are the cash flows that we can include under this category? Terminal year, right? So we know one thing is after tax salvage value, right? After tax salvage value. After tax salvage value, right? For that, I mentioned better to do separate working, right? It's better to do separate working, right? So, right. So we know this is how we did that working. Right. So I will put the working separately. Right. In this case, what is the cost of the asset? Cost of the asset? Cost of machine. Right. So in this case, the asset is machine. The cost is 400,000. Right. 400,000. What is the accumulated depreciation? Accumulated depreciation is the total of this row. 222,500. 580, right? 222,580, which means the net book value is this, right? What is the expected salvage value? Expected selling price? 157,500, right? There is a profit or loss?
Loss.
That $7, there is a loss. What is the loss? Right, loss is 19,980. And we have to calculate tax on that. The tax, 39% of this is 7,790. So salvage value is 157,500, and to that we need to add the tax saving. When you add the tax saving, you get the after tax salvage. Right? Is that correct? Is that clear? Right? So the cost of the machine is 400,000. The total depreciation, accumulated depreciation is, right, 222,580. You have to get the total depreciation for all the 5 years, which is 222,580. And then you get the net book value. Net book value should be compared with the salvage. It is an asset with the book value of 177,000, but the company is going to sell it to 157,000, which means there is a loss of 19,980. There is a loss. There will be a tax saving of 7,790, which should be added to the expected salvage value. The salvage value, the company expect to receive 157,000 for this asset. In addition to that, there is a tax saving of 165,290. Right? What is the relevant period? Terminal year 5. 165,290. Okay. Any other cash flow for the terminal year? Any other cash flow for the terminal year? In addition to this salvage value?
22,500.
22,500, exactly, right? So that is recovery of working capital. Recovery of working capital will be a cash inflow, 22,500, right? So now everything has been included except one thing. What is that? Opportunity cost. Right? So we can adjust the opportunity cost also. Opportunity cost, right? So which is, it's a special point. That's why better to adjust it separately, right? Opportunity cost. What is the opportunity cost? After tax rent income, right? After tax rent income. Because if the company start this project, what will happen? They will lose this rent income, but we have to use after tax rent income. What is the after tax? They will lose 15,000, but for the 15,000 they have to pay tax if they get the tax, income. That means what is the amount they really lose, right? So we need to adjust this tax, right? So we can put this way, right? That also, if I put a small working for that also, rent income, annual rent income is 15,000. If the company receive this, they have to pay tax. Tax. At so if they get this revenue at 39%, so which means 5,850 they have to pay as tax. That means what is the actual amount they will lose? What is the actual amount they will lose? The net amount, right? That is after tax rent income is, right? After tax rent income is the net amount, right? That is they will lose actually. What is the actual opportunity cost? 9,150, right? 9,150. They, that is relevant for which year? That is relevant for which year? Relevant for
All the years.
all 5 years. All 5 years, right? All 5 years, that is relevant. 9,150 they will lose. Now what you have to do? Now you have to calculate the net cash flow for all 6 years. Now you can calculate net cash flow for all 6 years, right? Because 5 years, including time zero. Time zero, right? What is the amount? And the other years you need to get the total right? So you better practice this, right? Because here I have put formulas and calculated very easily. Now once you get this, now it's done. Now it's done. So what you have to do, you need to insert these values to your calculator and get the results. NPV, IRR, payback, anything you can. Right. So now the calculation of NPV, IRR, payback, you need only one moment. Is that clear? So that's fairly detailed question, but that is not difficult. Right? Is that clear? Right? But important thing. So please do this question completely alone. Right? So you calculate everything alone. Then only. Right? So you here there is nothing complicated. Right? So usually this question include a lot of adjustments, sometimes more than some of the exam questions. Right? Therefore, when you practice questions like this, the exam question you can do without any difficulty. Right? So we can discuss a few more questions and then we can discuss even the next topic next week. Right? So is this clear? Is this
So
clear?
just one more thing. I still didn't get now. This is not a loss now in this financials.
Sorry?
So no, in this all the years it's a profit, right?
Which one?
No, here in all the years cash flows.
Yeah. All the years there are profits.
But after tax salvage value, how come it came with
Oh, okay. Yeah, so that's actually that means so for the profits they have to pay taxes. But if there is a loss, what will happen? Now, so due to this loss, what will happen? The amount they have to pay as tax will reduce. The tax
no,
payment is reduced. That means if this loss is not there, suppose there was no any loss like this, then what will happen? If there is a profit, what will happen? They have to pay more tax. But due to this tax, what will happen? The amount they have to pay as tax will reduce. So here, I think we did one example last day, right? So if the profit, right? For example, here in this question, we can see that clearly. Suppose without this loss, if the profit is 5,000, then they have to pay 2,000 as tax. If the tax rate is 40%. But if this loss is there, what will happen? The taxable profit will be reduced by this loss. Right now, there is a loss of 19,000. Right now, due to that 19,000 loss, what will happen? The taxable profit will be reduced. Now they have to pay less tax. That is what we call tax saving. Tax saving means the company will not receive cash, but company's tax, cash outflow is reduced. Reduction of outflow means it is similar to inflow. Is that clear? Because the point you mentioned is very correct. There are profit for all 5 years, right? That means for these profits they have to pay taxes. But when there is a loss due to certain point, right? Maybe due to a special. That's why we call this non-operating, right? For operating cash flows or for operating transaction, there are profits. But due to this loss, what will happen? The profit, the tax they have to pay will be reduced, right? The tax they have to pay will be reduced. That's why there is no real cash inflow, but outflow is reduced. Because when you are trying to manage your organization profit, if you increase revenue, profit will increase only by maybe 10% or 15%, right? Why? Because in order to increase revenue, you have to incur a lot of expenses. Profit will increase by maybe 10% or 15%. But if you decrease cost by 100 rupees, what is the impact to profit? Profit will increase by 100, right? So, right, that's why it is very important to consider this point. So, when there is a loss, what will happen? The tax payment is reduced, outflow is reduced. The reduction of outflow is similar to inflow.
Can you show the working for after tax rent working? Can you show it once again, please? After tax working.
Yeah. Okay, this one. I will send this file to you. right? But the important thing, so you can see to calculate this part, it takes time, right? It takes time. So that's why the practice is important. To calculate this manually, it takes time, and it includes several small working, right? And you should be familiar with these workings also, right? Then the calculation of NPV, IRR, payback, that is easy, right? Once you calculate this net cash flow for the project for all the relevant periods, now it is matter of inserting these cash flows to your calculator. You go to cash, insert the discount rate, and insert the cash flows. Then you can calculate NPV, IRR, payback, anything you can calculate so easily, right? So detailed comprehensive questions, we'll discuss several past paper questions, because there will be one complete question for 15 marks in the exam from this project evaluation, in addition to one short question in part A for 10 marks, right? That means 25 marks, right, from the points we discussed during the last 2-3 sessions, right? 35 marks. So you can get without any difficulty when you practice. Okay, any question?
Sir,
Yeah.
yes, sir. In this cost of machinery, this loss tax saving on loss, both the instances, why have we added? If we have in the first time when we have, it's a plus mark, so that for the salvage value, don't we have to reduce it from that?
Yeah. So if there is a profit and if the company has to pay tax, that should be deducted. But if there is a loss,
Why do you
right?
say it's a loss?
Because here this is the net book value, right? And this is the, okay. If I put that salvage value also here, then it will be clear, right? So what is the salvage value? What is the expected salvage value of this asset? The company, they have estimated they can sell this asset for 157,500, right? They have estimated they can sell this asset for 157,500 at the end of the once the project is completed, right? But once the project is completed, what is the book value of this asset? The cost of the asset was 400,000. The total depreciation is this 220,500. Means the net book value is this. According to the company's books, it worth 177,000. But what is the estimated selling price? 157,000. An asset which worth 177,000, according to the company's financial statements, they are going to sell at 157,000. So, is there that is a profit or loss? That means they are selling at a profit or loss.
Loss.
That is the loss, right? Asset worth 177,000. They are going to sell at. They have estimated they can sell at 157,000. That is the loss.
So loss is only the difference.
Sorry. Loss is
19,982 is the loss, sir.
Yes.
So, like after we reduce 19,982 from 177,482.
Yeah. No. Why we deduct loss from the book value? We don't deduct loss from the book value, right? Now, right? Why we calculate this profit or loss? If that right, so the purpose of calculating the profit or loss on disposal is to calculate the tax impact, right? So 19,000 we should not adjust to the book value, right? Now this is that is not a cash flow.
We are cross checking the tax component,
Tax
like
impact.
the percentage.
Yeah, exactly.
39%.
The entire purpose of doing this exercise is to calculate this value, right? We do
Calculate the tax value.
Entire calculation to calculate this figure, right? The purpose is to calculate this figure, right? Once we calculate this figure, that should be adjusted to the expected salvage value.
Right.
Because that is the purpose. That is the purpose, right? The entire, the purpose of doing this entire working, is to calculate this figure. What is the tax impact?
Okay. Because they
Yeah. Yes. Because right. So now due to this loss, right? Actually, for this cash flow analysis, this is we are not going to use this at all because this is a book value. That is not a cash flow, right? 400,000 company has to pay, 150,000 they are going to receive. These are the relevant cash flows that we have considered, right? This 400,000 and 157,000. We calculate to identify whether there is a profit or loss. Once we identify the profit or loss, we calculate the tax impact. If the company is going to sell at a profit, company has to pay tax. Another outflow is there. But if there is a loss, there will be tax saving. Tax saving means what? The outflow is reduced.
Right. Thank you, sir.
Okay.
Thank you, sir. Thank you very
so
much.
when we do several questions, so this will be more familiar, right? So then once you practice, if there is any other question, so you can ask. No problem.
Thank you, sir.
Thank you, sir.
Will you share the Excel sheet with us?
Yeah, I will send now. I will send.
Thank you.
Thank you, sir.
Thank you.
Okay.
Thank you. Good night.
Thank you, sir.
Thank you. Good night.
Good night, sir. Thank you.
Thank you, sir. Good night.
Thank you. Good night.
Thank you.